Hey guys, I got another question about property tax refund calculation. So I know that some people are really passionate about real estate, and the math is kind of what trips them up when they're taking their real estate license, their test for that. But I'm here just to show you guys how to think about it in a basic format. So I'm going to read this question to you. It says on February 1, the seller paid $1,140 in annual property tax for the current calendar year. So they're prepaying their tax for the entire year, which if you have a mortgage company, usually the mortgage company does that for you, and then you pay for it throughout the year. He's doing it. He paid it in full upfront. So it says he sold the house with the closing set for April 1st. Okay, so he's already paid his property tax for the whole year, and he's not going to own the house for the whole year. So he's going to get a big chunk of that back. Okay, so it says what will be the seller's credit, the money that he's going to get back for the property taxes already paid if the buyer pays for the date of closing. So they do that because you're closing on April 1. So they're not going to include that he doesn't technically own the house as of that day. So the buyer will pay that. So we're pretending that there's a 360-day year. I know there's 365 days, but they're doing that because they want it to work out with 30 days each month. Um, and there's 12 months. Okay, and then that way we know every month doesn't have 30 days, but that way you can easily calculate an estimate. So that's probably what your tax people are going to do, um, in order to just give you like the average back of what you would have paid for those 12 months. Okay, so this is how we start off. First, we know that he paid $1,140 in annual property tax. Okay, so this is how much he paid. Now, we know the way the tax people are going to refund it is based on month. Okay, so I see he paid on February 1st, and technically the last day he's going to pay is March 31st. But we're pretending that all of February and all of March only have 30 days. Okay, so we're going to call that 2 months. Okay, well, 2 months out of the year, I know there's 12 months in a year. So he's going to have to pay those 2 months, but the remaining 10 months are what he's going to get back. So I want to figure out how much is he paying per month here, because that'll easily help me find out how much he'll need to get back for the 10 months. So once I break it down, I find out how much would he get back for every single month. So how much is he technically paying per month? So I take this number, 1,140, put it into my calculator because they should give you that on your test, because that would be cruel if they didn't. Some of us haven't done long division for a really long time. So this would be $95 per month. That's actually pretty good because I'm here in Texas and property taxes are much higher than that here. So then we know that that's how much he would pay every month. But he's only paying for 2 months because that's all he's staying there for. And we want to know what his credit's going to be. So the credit would be the other 10 months that he's not going to be living in this house. So we know that per month he would be paying this, $95. But we know that he's not going to be there for 10 months. So those 10 months he has to get back. So I don't even have to plug this into a calculator because I know anything times 1 is just itself. So 95 times 1 is 95. Add a power of 10 back, I get $950. So this is how much he should be seeing as a credit on his day of closing. Oh, don't forget to subscribe and like this video.